Hello, Ivan here with Isla Vancouver Wealth Management. September has arrived. I hope you all had a good summer. With September usually comes volatility. And when we see volatility in financial markets, it is a good idea to grab some perspective to look at the big picture. In this video, I would like to show you the big picture. Let's take a look. This great interactive tool provided by my friends at BMO Asset Management, we can see what different asset classes have done since 1935. By far, U.S. stocks have done the best in $1,000 back in 1935, and U.S. stocks would be $19 million and $235,954 as of the end of 2023. That is amazing compounded growth. But you can see that the road there was not an easy one. It was one filled with ups and downs and quite a bit of volatility. It is unlikely that someone would have remained invested that whole time, but you get the point. Now, far second is Canadian stocks, and if you invested in Canadian stocks since 1935, $1,000, you would have now $3.5 million roughly. Then we have international stocks, 1.1 million. Canadian bonds, you would have a decent 136,000. T-bills or government bonds, Canadian government bonds, you would have 40,139. You would still be beating inflation. $1,000 from 1935 are roughly 22,000 as of the end of 2023. The reason that many investors don't stay invested when they should is because the bad times, the downturns, are felt much more strongly than the good times. Now, some perspective on this, we see different rolling periods of different asset classes. So for example, if you invested in US stocks, of all the 1 year rolling periods, you had positive returns 79% of the time, with your median return being 13%. The best year ever was 83%, and the worst year ever was negative 51%. You can see the longer the periods are, for example, the 3 years, you had positive returns 85% of the time in US stocks, with the best return ever 35% on average, and the worst one negative 16. Now, if we move it to a 10-year rolling period, then the picture is much more stable. You will have positive returns 95% of the time with US stocks, whereas with Canadian stocks and a moderate portfolio, Canadian bonds and T-bills, you have positive returns 100% of the time. Something that investors say to me often during times of volatility or during a downturn is, it will never come back. It's too far gone. This time is different. I don't have the time. And the impulse of getting out of their investments is too great. But look at this. Canadian stocks back in the three of the biggest downturns of our time, the 1980s, 1 month after the bottom, stocks returned 4%. After 6 months, it was 47%. After a year, it was 87%. After 3 years, it was 123%. And after 5 years, it was 227%. It was well worth it to wait and be patient. Granted, you should be invested in investments that are appropriate for you with the help of your financial advisor. But the moral of the story is, if your long-term goal is to create wealth for a future that is not immediate, then You need to choose the appropriate mix with the help of your financial advisor to achieve your goals. We're not talking about short-term needs such as the down payment of a house or buying a car in 2 months. Building long-term wealth takes patience, takes discipline, and good advice. Give me a call, please subscribe, and I would love to talk to you soon.